Going to go ahead and get started. Hi, everyone. My name is Lena, and I am with Provident Credit Union. Thank you for joining us for today's webinar, where we will be discussing our Smart Option Student Loan Program. This webinar is being recorded. All participants have been muted, so please use the Q&A box for any questions. All attendees will receive a follow-up email with today's recording and presentation deck within a week. Your presenter today is Jeff Lackey. He is the Director of Relationship Management at Sallie Mae. And with that, I'd like to now hand it off to Jeff. Welcome, Jeff.
All right. Thank you, Lena, and welcome, everyone. Thank you for joining us this afternoon. Really appreciate you turning out. And yes, so today's going to be kind of just basically an overview of the program. We're going to kind of touch upon a few concepts today where we kind of want to set the stage, so to speak. So we'll kind of talk a little bit about helping students save, plan, and pay for college, but it's going to be kind of more of how college is with the parameters that financially can kind of get awarded on, some of the reasons why you may be potentially having to look at student loans. Obviously, there's other options, aid options out there and such that, we always encourage students to take a look at. So we'll cover those first. But then if it's determined that you will still need, loans moving forward, that's what the deeper dive of today's presentation will be on is what that specific gap loan or a private loan would be utilized for. We're going to talk about those features and benefits so that you can learn more about it and feel more comfortable about the product that Provident Credit Union, as well as Sallie Mae, in partnership with Sallie Mae, offers. We're going to talk a little bit about some of the repayment options that you can see, as well as what you would be, what you could see while you were in school and such. And then lastly, just kind of some tips and account management tricks and such like that for you to kind of be aware of. Whether this is going to be your first loan, or if we have family in attendance today helping instruct potential first-year students and such. This could be your first loan, or it could be one of many loans that you've taken out in the past, but maybe you're not as familiar with an education-related student loan. Maybe you're more familiar with mortgage loans or car loans and such, so automobile loans. So we want to kind of set the stage from that perspective. So again, talking about setting the stage, when you are planning on attending school, there's going to be a various different types of costs, essentially, that you would be becoming familiar with. And essentially, the idea and the premise behind that is that as you're attending school, if you're going to a traditional or a four-year private, many of them may be eligible for federal aid or various different state aid options and such. And with that, what they typically will do is they will create budgets. They will be estimated budgets. Again, if you think along the lines of a UC or a CSU school where you've got anywhere from 25 to maybe 38,000 students, it would be very difficult to create individual budgets. But having said that, what they will do is kind of create an estimated budget. And when they're building that estimated budget, which we'll refer to on the next slide, and it's basically going to be called the cost of attendance, that cost of attendance can have various different figures in it. You can see a few of them here. Those figures that will be built into a cost of attendance are going to be separated out between what is called direct costs and your indirect costs. And your direct costs are going to be things that the school will bill you for directly. So essentially, think of along the lines of tuition and various different fees that are associated with tuition, as well as any housing and meal plan. If you happen to be living on campus or you happen to be in a campus managed apartment complex and such, you may still find that your bill is coming directly from the college. And then, of course, also to any other additional fees, maybe like a health center, student activity lab fee, maybe a health insurance fee, something along those lines. Those are something that the college or university controls directly and that they will bill you for directly. Now, the flip side to that is that because you're going to be attending school, chances are there's going to be, additional things in life that you still need to be responsible for that may not necessarily be billed directly from the school. And that's going to be obviously your books and supplies. Now, obviously, there's some bookstores that are on campus and such, but there's a myriad of different ways that you can get books nowadays through partnerships with with online companies, maybe even some different types of online streaming service and such, ebooks, for instance. So sometimes we will find that the school is not responsible for billing your books and supplies. And essentially that would be an indirect cost. Now, indirect costs also too can be any type of equipment, your art supplies, your computers and such. And again, this can vary between school to school. Sometimes a school can bill you directly for art supplies or a specific type of hardware or software system for a computer, depending upon the class that you're in. But chances are you're going to be accruing that separately or outside of the institution. And so think of the different types of equipment that you may have to potentially purchase or acquire. Obviously, transportation. Now, again, if you're living on campus, chances are that may just be a walk from your dorm room or from your campus managed apartment. But again, if you're a commuter student or if you happen to be living off campus and you may be living in an apartment complex or a shared home or something along those lines that might be a mile or so away, you still have to pay for transportation, whether that be your individual car or maybe a public transit service. And then, of course, personal living expenses. So think of toothbrush, toothpaste, personal supplies and such like that, clothing, and various other things that kind of fall within that. Even an occasional meal out every once in a while that doesn't necessarily have to fall under meal plan. Those are all what would be considered your indirect costs, something that you are accruing while you are going to school, but is not billed directly by the school. Now, both the federal government and some state aid institutions do allow for what is called education-related indirect costs to be paid for by various different financial aid offers or by the awards, the actual plan. Maybe that be a Pell Grant or a Cal Grant, for instance, in the state of California, maybe various different federal student loans. Those are, if a financial aid office at a particular school builds a cost of attendance with these direct and indirect costs in there, again, it is allowable to have financial aid take care of some of your education-related indirect costs. So as we mentioned on the previous slide, so those direct costs and indirect costs will be estimated. They can use some actual figures, maybe let's say tuition, but chances are they're going to create an estimated cost of attendance by utilizing other numbers. Again, they may have 3 different types of housing plans. They may have 5 different meal plans, whatever. They will probably put in an estimate as to what either the most popular housing and meal plan is, or maybe they might potentially use the most expensive one, for instance. But anyways, a financial aid office will build a cost of attendance out of those direct and indirect costs. What they will do is they will subtract them from your FAFSA-related student aid index number. If you file the free application for federal student aid, which is a federal document for federal financial aid eligibility, they will subtract that from the cost of attendance, and then you will have what is called your financial need. Your financial need is what the financial aid office will try and meet as much of as they can with various different financial aid awards, Pell Grants, Cal Grants from the state of California, federal student loans, work study, anything else, okay? So that's basically how the equation works. And what we're going to talk to you today about with the private student loan is its role within that potential financial need, that basically that exponent at the end. So what we would like to do is, before we talk about any type of student loans and such, we want to remind everybody out there that there is what we would consider the 1, 2, 3 approach. And basically, this is a recommendation for you to consider when looking at ways to fund higher education. We want you to start with money that you don't have to pay back, and you can supplement your savings and income by maximizing scholarships and various different grants and work study. Number 2, taking a look at the FAFSA-related eligibility of awards through federal student loans, any other types of other federal grants that might be available. We always encourage students to explore federal student loan options first, like what would be considered the subsidized and unsubsidized direct loan. Go ahead and consider those first, and then you can be eligible for those or have your eligibility determined, again, by filling out the free application for federal student aid called the FAFSA. That information will be received by the financial aid office, and they will work on determining your eligibility and the amounts that you would be eligible for. Third, and that's what most of today's presentation is going to be focused on, is after you've exhausted the free aid options and you filed the FAFSA and received all of your federal aid options, including federal student direct subsidized and unsubsidized loans, then you would want to consider a responsible private student loan. And basically, this loan is what's going to be used to fill the gap between your other available resources as well as the cost of college. So that basically that unmet need of the financial need that maybe a financial aid office wasn't able to cover. We always encourage students and their families to evaluate all anticipated monthly loan payments first and make sure that students understand, what they're going to earn in the future before considering a private student loan. So let's go ahead and move into the Provident Credit Union offered by Sallie Mae student loan programs. We've got various different loans that are available to you depending upon what level of education that you happen to be pursuing in your educational journey. Obviously and arguably the most popular is going to be the Smart Options student loan. And this loan is a private student loan. Again, what we would consider that loan used for the gap, which is basically the aid need that you have between eligible aid that you've received either through free aid options like scholarships and grants, and then of course federal and state aid options through other types of grants and maybe federal direct or subsidized, unsubsidized student loans. This Smart Options student loan is for undergraduate students. So basically you have to be seeking a bachelor's or associate's degree, or you have to be trying to obtain a certificate at a degree granting school. We also have within the Smart Options student loan, the career training wing, which essentially is for participating non-degree granting schools for professional training and trade certificate courses. So think of your career trade schools, your vocational schools and such. Both of them are eligible and various schools are eligible for the Smart Options student loan. And so from that standpoint, we on our side at Sallie Mae work with schools to determine which program that particular school and their degrees or certificates that they grant, which program they would be eligible for. You as a student that would be applying for that loan would simply just be going into the link either provided by their school or starting off at Provident Credit Union's website and clicking on that. And then essentially the application would walk you through what loan that you would be eligible for based on the information that you give us, essentially what school you'd be attending and the type of degree or certificate program you'd be attending. We also have for graduate students, we've got various different loans that are offered. If you happen to be obtaining your Master's in Business Association, your MBA, we've got law school loans, and this is for both JD as well as LLM programs and such. So this loan would be particular eligible for all types of different types of law schools. Not only for the state of California, but all throughout the United States and even some foreign institutions that are eligible for our programs. We also have available to us for graduate students, professional students, the medical school loan. We also have loans for health professions, dental school, as well as a general graduate school loan. So think for engineering or master's in humanities, master's in education, for instance. All of these loans are available and eligible depending upon the degree or certificate that you happen to be pursuing. We even also have loans that are available for students postgraduate. So if you happen to have graduated with your Juris Doctorate from law school, or if you happen to have been an MS4 student, medical student for, so you've graduated, or in the process of graduating and you're currently attending as a fourth year student in medical school or dental school, for instance, you have eligibility for a residency and relocation loan. So think of these loans, both the bar study loan and the residency and relocation loan, as loan options for you to bridge the gap between your education as well as when you actually have to either sit for the bar or maybe by chance, to offset some of the costs or supplement some of the costs that you are going to incur while you are attending resident. These loans, both of these loans can be obtained in the last year of your program. So the third year of your law school program, or maybe fourth year of your LLM. And then, of course, you can also obtain the residency and relocation loan for your medical professions, both medical school, both allopathic, osteopathic, and such, as well as for dental school and DVM, Doctorate of Veterinary Medicine. This loan is eligible for it. So these loans can, like I said, can offset additional costs. Think also to using the residency and relocation loan, maybe for incurred interview costs, or maybe attire if you happen to be going, you need a new suit, or you need some planning materials and such in order to interview well during your 4th year for residency, and you're waiting for match day in March. You are incurring additional costs that may or may not necessarily be covered by your school. So these loans are eligible for you as well. So with all of our loans, whether it be the Smart Options student loan, which is for undergraduate students, as well as the suite of graduate loans that we have, the Provident Credit Union, offered by Sallie Mae Loan, offers very competitive interest rates. They are, sliding scale. They can basically be, you have the choice between variable interest rates or fixed interest rates on these loans. You can go through the application process, and once approved, you can make the determination as to which loan, based off of the rate that you've been quoted. You can decide whether you would want to pursue the variable rate, or you can go with a fixed rate option. So it's your choice as to which way you want to go. And it is locked in life for that loan throughout the total repayment period, as to what that interest rate index choice will be. So if you choose variable rate, it'll be variable rate for the life of the loan through repayment. If you choose fixed rate, it would be for the life of the loan through repayment, through the last repayment period. Now, if you take out subsequent loans for years 2 and 3 and 4, maybe of school or so, you have the choice of making a differentiation or choice each and every time that you apply for a particular loan. So just because you choose it your first year, and you would come back the second year and apply again for your second year studies if you need an additional loan, you get to make that choice from the beginning again as well for that new loan, what interest rate you would like to, interest rate index you would like to use. There are no origination fees on these loans. So sometimes maybe if you've gone through school before, or if you're currently looking at school, and you've been presented some information about other types of education loans, and you see some verbiage there that says that there's an origination fee of either 1.059%, or maybe an origination fee for parents of 4.228% on a particular loan. Essentially, an origination loan is a portion of the loan that is taken out to offset the costs of the administration of that program, that you are responsible for, but yet you don't get to use those proceeds towards your educational related expenses. So essentially, if you borrow $10,000, and let's say it's a private parent, or excuse me, a federal parent loan, for instance, that parents are taking out on behalf of their student, you're asking for $10,000. You will get roughly, give or take, $9,577 to go towards the bill, but yet you are still responsible for having to pay back, the full $10,000. With the Sallie Mae Smart Options student loan, that there is no origination fees on our loan. So if you ask for $10,000, you get $10,000. As well as there is no prepayment penalty on these loans. So if by chance you're taking out this loan, and it is to bridge the gap in between when you have available liquid assets, liquid cash or so coming available, or if maybe by chance you happen to get a bonus after you've, or a signing bonus, for instance, after you've graduated, you've gotten a new incentive plan at work and things have been well, and you want to either make a lump sum payment or you want to pay the loan off completely, you have the ability to do so, and you will not be penalized for doing that. There are, like we mentioned, there are multiple repayment options with, like I said, our Smart Options student loan and our graduate school loans. So this would be all of the law loans, or the Smart Options student loan, Smart Options student loan for career training. It would be all of our graduate suite of loans. The payments are deferrable while you're in school, which means that if you wish, you obtain the loan, you're approved for the loan, and the loans are getting dispersed out to the school. You can defer the entire principal and interest while you're in school, which means that you're not responsible for making payment while you're attending school. You can opt, if you wish, to pay a monthly interest or pay the monthly interest while you're in school as well. So the nice thing about, if you're paying the monthly interest while you're in school and such, that actually can end up being quite a benefit for you because, obviously, as we know, student loans and such are loans that you have to pay back. And so from that aspect, if there's ways that you can save money by taking out that loan, you certainly want to take a look at that option. The nice thing about the interest repayment option is that if you decide that you wish to do that, you can save up to roughly 13% of the total loan cost by choosing to pay the interest repayment option when you're actually in school, so that when you graduate, all that you owe is the actual principal amount that you initially asked for. So again, using the example that we had prior, if you decide to borrow $10,000 your first year in school, so your freshman or first year, and then maybe that's the only loan that you need to acquire while you're going to school, if you were paying the interest on that for years 1 through 4, when you graduate and you start into principal and interest payments on that loan, you are going to start making principal and interest payments on that loan on the $10,000 only because of the principal portion. And then, of course, any future interest is accrued that's worked within your payment. But you don't have all of that accrued interest from years 1 through 4 that then gets added to that loan, of which then you have to start making principal and interest payments on. So you can really end up saving, like I said, on average, roughly 13% of the total cost of loan by choosing your interest repayment option. Also, too, if you do decide that you want to pay the interest while you're in school, there's an interest rate incentive that is demonstrated to you when you're applying for the loan and choosing your repayment option that you may want to take advantage of too as well. It may end up as actually ending up costing you less through the amount of interest that you would be accruing by taking advantage of that interest rate reduction that's offered to students that decide to pay their interest. Also, too, we have what is called a fixed repayment option. You can pay the fixed amount each month while you're in school. So basically, this fixed repayment option is basically where you would end up paying roughly $25 a month while you were going to school. The idea and the premise behind that is that it's something that you can pay. Hopefully, $25 is not something that would be taking too much of an impact in your budget while you were going to school. The nice thing is that it kind of gets you used to making payments on your loan without actually, like I said, affecting your budget, especially if you decide that you either have to have a reduction in hours at work while you're going to school, or maybe you decide not to work at all while you're going to school. And maybe income is not coming through as much while you're trying to obtain your degree. But yet you still want to save on your loans. You still want to demonstrate or practice responsible repayment habits. So you can opt for the $25 fixed repayment option. This can save you roughly 6% of the total loan cost by choosing this option instead of deferring your loans completely. The also thing that's nice about the interest only option and the fixed repayment option is that both of these options can help you build credit and manage your budget more easily. So it's something to kind of consider if that's what you want to do. So as we discussed on the first slide of our presentation, we have various different costs of attendances. And within those costs of attendances, you had your direct costs and your indirect costs. One of the questions you might have had was, well, what can these loans go for? Where can I use these loans? Or, as I'm learning more about financial aid, and maybe I've received a financial aid offer from my school, there's certain awards that can only go towards certain budgets, certain line items, like it can only go towards tuition or whatnot. With a private student loan, and with our Smart Options student loan that's offered through Provident Credit Union, partnered with Sallie Mae, this loan can be used for all different types of school certified expenses. And you can see the same categories we had at the beginning of the slide presentation. It can be used for your tuition costs. If you have additional tuition costs, it can be used for fees. It can be used for books, supplies, transportation, computers, and cost of living. Now, these loans will be certified by the school, which means that once you apply for the loan, upon approval on this loan, the certification will be sent to the school to certify the amount. Make sure that you're not asking for too much more than what is actual the cost of attendance. Make sure that you're eligible for it, you're properly enrolled, making sure that you're not over the cost of attendance. Let's say that you filed the FAFSA and maybe you've received another scholarship outside. So, when we were doing that cost of attendance minus your student aid index number gives your financial need. Well, that financial need, based on all the various different financial aid awards that you can receive, we cannot go over that full cost of attendance in that equation. So a financial aid office needs to balance and budget. Maybe they'll have to change the amount. Maybe you ask for $10,000, but you're only eligible for $8,000 within that cost of attendance. Financial aid offices will make that determination for you and then basically state that this is the amount that you're eligible for. They will certify that loan, verify the loan periods that loan is eligible for, and then they will send it back to us. Based on the loan period disbursement dates that they have asked, we will have those disbursements ready and sent out to the school. The loan proceeds, with the exception of the bar study and the residency and relocation loan, all of our Smart Option student loans, Smart Option for career training, all of our graduate suite of student loans will all be dispersed directly to the school. And the school will have a application policy. Typically, what they will do is apply it to your balance. So they will pay off anything that is currently owed. And if there is more money in your disbursement than what you were being billed for, you're eligible to receive that back in the form of a refund. And the school will either ACH or wire it to an applicable bank or checking or savings account at a credit union for you that you choose. And you can use that refund to use towards your education related expenses, or they may issue you a check, of which then you would just simply take it to the credit union and negotiate it. But that's exactly how you would end up paying for your outside supplies, your indirect costs for transportation, your indirect costs for cost of living. So that's essentially how that process would work. So you're probably asking yourself, okay, I've gotten a lot of great information now. This is great. How do I move forward on this? Or where can I grab some more information? Once you have decided, like I said, you've gone through the 1, 2, 3 approach, have explored, and that you're constantly exploring free aid options, constantly looking for scholarships and such, because again, any free aid money that you can have go towards your education is going to do one of two things. It's going to offset the amount of money that you have to borrow, or it's going to offset amount of money out of your checking or savings account that you would have to pay out of pocket. So constantly be looking for scholarships. But again, once you've made that determination that you've looked for free money and you've qualified for other types of federal or state aid monies, what you would do is you would simply go out to the website listed here, providencecu.org/products/personal loans, and then Smart Options Student Loan. Now, again, this can be accessed directly off the providencecu.org website. And you would just click on personal loans and you would see the link farther, a little bit down on their page. And it would basically take you directly to student loans. There is no cost to apply for this private student loan. You can apply for it. Because these loans are credit-based, these loans are, you will have to go through a credit check. And so with that, if you are applying for this loan, before you hit the submit button, understand that it will be checking your credit. And that you may find that either, you qualify for the loan, you may find out that you don't qualify for the loan. And if by chance you don't, then there will be a kind of a guide as to what went into the determination for why you did not qualify for the loan. And there may be chances to remedy that and reapply at a later time. Or maybe by chance, it gives you, some information that you may want to consider applying with what is called a cosigner. And you can see the bullet point farther down there where you may want to talk and think about applying or reapplying again with a credit-worthy cosigner. But again, once you're filling out the application, you can fill out the basic and personal financial information right on a mobile ready website. You can apply either over your mobile phone. You can go to a laptop. You can access them both ways. Apply for the loan. It takes roughly about 15 minutes or so if you have everything ready with you at that time to receive a credit result. And then once you've received that credit result, like I mentioned on previous slide, it will say, congratulations, you've been approved. And here are some interest rate types that you may want to consider. And oh, by the way, here's some repayment options that you may want to consider for this loan. So again, fairly easy, all things considered, in order to take out that loan. It's again, an education related loan. So again, this is a loan that would have to be used towards education related expenses, and it will be sent to and certified by the school. Now, again, just because you've applied for the loan and you've been approved, we will go ahead and transmit for certification to the school. However, one thing that kind of comes up with students and applicants that are wondering, how come I haven't heard from the school? How come I haven't seen a finalization of this product yet? And in part because some schools may not be ready to certify loans. In fact, a lot of schools will not look at upcoming certifications for loans until after July 1st, for instance. So if you're applying for the loan now, you do your application, takes 15 minutes to apply, you get approved, everything's great. If you decide to call down to the school the next day or the day after and say, I've done my loan, when am I getting the proceeds? When will it be dispersed? You'll want to check with your financial aid office and find out when they will be certifying that loan. Because again, just because you've been approved doesn't mean that the process is completely done. We still have to wait for the school to certify their portion, verify your eligibility, verify the loan amounts, the disbursement loan periods, enrollment, what have you. And again, schools can sometimes work on their own calendar based on if they're finishing up the last period, academic year 23-24, and they're not ready to certify loans for academic year 24-25 yet, or something like that. So again, remember that there's a two-step process in order to receive the monies from a private student loan. So, talking about some repayment options on these loans. Again, we talked about the repayment options of while you are in school, and here's a graph that shows some of those numbers that you may want to consider. Again, thinking about if you would want to choose interest-only payments while in school, or maybe a fixed repayment while you're in school, or if circumstances are what they are and you have to defer the entire principal and interest while you're in school, certainly you can take a look at that and see what it will do. And that is certainly your option if you decide to do it. But this graph just basically shows you a little bit of some of the options that you may want to consider in regard to this. Like we said, it helps you build credit if you are in an actual repayment program while you're in school. So when you do graduate, and maybe you are going to think about obtaining that first auto loan, or maybe a couple of years after graduating school, you're thinking about applying for a mortgage loan, you're going to have 4+ years of making payments on your loan that will be recorded within your credit history. And that can be somewhat advantageous for you as you move forward. Also, too, we talked about how it will reduce the capitalized interest. And essentially, again, that's the unpaid interest that's accruing on your loan while you're going to school. And in so doing that, it lowers your total loan costs. So you'll want to think about that, and you can kind of see some of the numbers and the figures here of how that would actually impact you. So kind of thinking about, all right, this, I've heard a lot of information. I've got some options. I want to go back and look at some more scholarships, but I'm pretty sure I'm still going to have to take out a private student loan. You'll obviously want to consider your financial situation. You'll want to kind of consider what your starting salary and your debt load is going to be. So, if you're starting into school, or if you're currently at school, but you haven't declared yet, think about that major and think about that career that you're going to be obtaining. And that's got to be commensurate with the debt load that you are going to be willing to want to take out in order to achieve that degree or certificate program. So always keep that in mind. I can't necessarily tell anybody exactly how much they should borrow because each circumstance is different, but definitely analyze that. Talk with folks at the school, do some online research on what the average salary or starting wages for a degree that your certificate or program of study that you happen to be obtaining. And then think about the debt load. And this is going to be all debt loads, whether you're borrowing federal student loans, maybe they're the institution you're attending, maybe they have an institutional loan, and of course, obviously, the private student loans that we're talking about today. Again, you may want to also, talk about your fixed interest rates. We touched upon them for just a short period of time, but maybe you're not familiar with what a fixed or a variable interest rate is. Fixed interest rates, they have a certain appeal to consumers as they kind of convey a sense of stability. While a variable rate can go up, it can also go down. Fixed rate loans may be the most beneficial for loans with a long lifetime. And, you could be looking at this loan for anywhere from 12 to 15 years that you may potentially be in repayment, plus any years if you happen to choose interest or interest only or fixed repayment while you're in school. So again, fixed interest rate might be the most beneficial for loans over a long lifetime if you think you're going to be paying over the full 15 years, as they can provide stability through extended period of time. However, though, variable rates, they can sometimes be more beneficial in a lower interest rate environment, especially if your goal is to help pay the loan off sooner rather than later. And commonly, fixed interest rates are higher than starting variable rates since, lenders essentially were absorbing the risk of rates increasing. So we always encourage borrowers to evaluate both your fixed and your variable rate loan options. Another element that you may want to consider in shopping and looking at a private loan is the benefit programs, that are offered. You can see some of the benefit offered. We've talked about one that we offer right now currently, and that is if you decide that you want to go with an interest only option while you're paying, you can get up to 1% off of your interest rate reduction if you decide to go with that. And again, thinking longer term, if you happen to get a 1% interest rate reduction, you're paying your interest off, so you're saving money there, and you're also getting an interest rate reduction on what was the initial quoted interest rate of that loan. So your loan interest is not accruing as fast. That would be a benefit that you may want to consider and have go within your option on whether you decide to pay your interest while you're in school or not. You may also want to see, also too, if I do take out this loan, do I want to take advantage of maybe an additional 0.25% interest rate reduction if I happen to have my monthly payment come out of my credit union checking or savings account? If we can automatically deduct that each and every month when payments are due, the benefit is you get a 0.25% interest rate reduction off of that. Also, some other features and benefits. Sometimes these can be synonymous, a feature and a benefit. But you may want to also consider, the repayment term. Again, there is no prepayment penalties on these loans, and depending upon the amount that you initially have to borrow, you can be assigned either a 12 or a 15-year repayment term. So you'll want to consider that. And again, obviously, shorter repayment term means that you'll be paying less interest over time. However, you may be looking at a higher monthly amount that is something that you'll have to consider when you're, making your payments. Obviously, fees. You'll want to take a look at any fees and understand that although there's no origination fees, if by chance you happen to miss a payment or you're late on a payment or so, you'll want to make sure that you'll understand that there may be a potential fee or so that's would be charged or so for missing that payment. So again, when you apply for your loan and you are approved, you will get what is called a disclosure statement. You will also get a promissory note. And within both of those documents will outline, and you'll have to understand and agree to these before final acceptance of the loan, that you'll understand that there are some fees and such if you happen to, for instance, be late or miss payments and such. We talked a little bit about cosigners, and we didn't really do a massive deep dive into cosigners, but the idea and the premise is that, with a cosigner, maybe you're trying to apply for the loan and that you just don't qualify for it right now on your own. And it doesn't necessarily mean that you've got bad credit. It may just mean that you have a lack of credit. Again, talking about that, whether you decide you want to apply for or apply for the interest only option while you're in school, or if you're totally deferring. If you have no credit now and you virtually build no credit while you're in school, when you graduate school and you start your career and maybe you got to get a new car or a new to you car or something like that, you need to take out an auto loan, or maybe you're ready to buy a house and take out a mortgage loan. If you don't have sufficient and enough credit, you will not qualify for that. Now, it doesn't mean that you're bad and that you've got anything derogatory. You just don't have enough credit. They haven't assumed whether or not you will be a good risk, a moderate risk, or a bad risk. And so with that, you may potentially, in order to qualify for a loan, you may need to have a cosigner, somebody that is willing to cosign or partner with you on that loan, by which a lender, Sallie Mae, can make the determination on whether you would be approved or not, because now we're looking at two people's credit history in approval of that loan. The cosigner is equally responsible for that loan. However, the loan is in the student's name first, with the cosigner being the second. But if for some reason the student or initial applicant does not want to pay on the loan or can't pay on the loan, the cosigner essentially would be responsible for that loan moving forward. Sometimes cosigners may not necessarily want to be a partner on the loan, for instance. They've got their own goals, their own ambitions, they got their own reasons and ways that they want to spend their money, and maybe they don't want to take that risk. So with a cosigner release option, the nice thing is if you are having to approach a cosigner and talk to them about that, you can mention to them, I am planning on attending school. In order to do so, I need to take out a loan that's credit-based and I don't qualify for it on my own, and I'm asking for you to be a cosigner. But I'm going with a program through Provident Credit Union and Sallie Mae that basically offers a cosigner release. And our cosigner release is essentially that after a student has graduated or left school and they have made 12 payments on time, principal and interest, that the student can apply to have the cosigner released from that loan. And what will happen is Sallie Mae will run another credit check, very similar to the credit check that we would run for you to initially be approved for the loan. However, now you've graduated from school. Chances are you're in your career. You have a different salary that you're earning now. You have a stable job. We will take a look at that and make a determination on whether or not you can have that loan by yourself. Can you handle the principal and interest payments on that loan by yourself now, and that your applicable debt to income ratio, all of that, pencils out basically based, on a credit scoring system. And if that happens to be the case, then the cosigner can be released from the loan. So sometimes that can be really great within the conversation and looking for a cosigner to let them know that that cosigner can be released. And then lastly, this is an unfortunate topic to talk about, but if by chance something were to happen to you as the applicant, the student, and you were either to pass away or you were to become permanent or totally disabled, Sallie Mae does have what is a death and disability waiver. So essentially, if you, the applicant student, happens to either pass away or you happen to be totally or permanently disabled, any future balance on that loan will be forgiven. Obviously, there will be a check that we would have to ask for. We'd have to verify, some certain information. But once that verification has happened, essentially any future balances on that loan would be forgiven. If you happen to have a loan that is co-signed, meaning you've got a co-signer with you, and you as the student become totally or permanently disabled, or unfortunately happen to pass away, not only is the future disbursements canceled, but that obviously means that the co-signer is not responsible for the loan moving forward either. So that's kind of interesting and a nice feature to have in a very, very unfortunate circumstance. If something were to happen to you or you were unable to be able to maintain your livelihood due to a total permanent disability, it's nice to know that there are some protections out there, not only for you and your family, but also for the cosigner as well, which might be a relative, it might be a parent, or it might be a really good friend, and they would not have to be responsible for that moving forward. So managing some private student loan tips and tricks. Again, benefits to having a cosigner. We've talked about them. A cosigner can be anybody. It can be a parent, any adult that has good credit, anybody that you want to have, a really good friend, maybe a spouse, depending upon your situation. Cosigner can help increase the chances of being approved. Like we talked about, there are some interest rate savings, 1/4% interest rate reduction if you happen to pay with auto debit by using your savings or checking account as a way that you would make your monthly payment that we have access to. The in-school repayment options, there could be additional ways that you can receive interest rate reductions based on that. And then lastly, too, within these loans, we didn't touch upon it, but you're going to school. You're not obligated to make payments. Maybe you're making interest payments or making a fixed repayment option if you want. You're responsible for that throughout the entirety of the loan. However, if you're going to school, you are not responsible for having to make principal payments as well, the principal part of the initial balance plus the interest. Once you graduate, you have what is called a grace period. And a grace period is a period of time between when you leave school and when you actually have to make payments on your loans. With the Smart Option student loan and some of our graduate suite of loans, like the graduate student loan and our health professions loan, you have a 6-month grace period on these loans, which means that you can leave school, graduate or leave school. You've got 6 months that you do not have to make payments. So think about getting your career started, think about moving, think about finalizing or applying for any licensures or certificates or exams that you need to take in order to be employed, whatever the case may be. You've got 6 months to get all of that done before your payments will go into effect. With some of our other graduates centric loans, like our law loans, for instance, law school loans, you have a 9-month grace period. And on our medical school loans, you have up to 36 months grace period on those loans. And so essentially 36 months, allowing for roughly 3 years of residency while you're going to school, that you would not be obligated to make principal and interest payments during that grace period. So those are some nice benefits and such to offer that are offered on these types of loans as well. So we've talked a lot of information today. We've touched upon some of the features and benefits of the Smart Options student loan, but we've also talked a lot about things that you may want to consider in regard to college and education and such, like, before you actually go into applying for a student loan. If you'd like to find more information out or help kind of re-solidify some of the things that we talked about today, certainly visit this website. It's Enrich, it's Providence Free Financial Wellness Center. They've got links on there that talk about student loans and some other benefits there. Of course, you can learn more about the loan that we talked about today as well. So certainly take advantage of that. And of course, you'll have obviously Lena and her team at Provident Credit Union to certainly learn more about this loan program too as well.